Commodity overview and catalyst breakdown. Crude oil futures are experiencing a sharp downside adjustment today, with West Texas Intermediate pulling back to trade near $84.30 per barrel while Brent crude consolidates near the $88.10 mark. The primary catalyst driving today's price relief is a significant de-escalation signal in global geopolitics. Confirmation that the United States and Iran have paused military strikes, alongside active diplomatic talks brokered via Oman regarding maritime security. Furthermore, shipping traffic reports confirm that commercial vessel transit through the critical Strait of Hormuz choke point is proceeding smoothly without fresh military disruptions, stripping out a substantial short-term risk premium that had previously pushed prices toward triple-digit territory. Macro drivers and central bank forces. To evaluate the broader macro trajectory for crude, we must monitor foreign exchange mechanics and central bank policy. When energy prices stabilize or pull back, headline consumer price index prints experience immediate relief, clearing a smoother path for the Federal Reserve to navigate interest rate policy without fresh energy-driven inflation shocks. Simultaneously, the US dollar index, DXY, plays a vital role. With the index trading near 101.40, currency stability continues to support dollar-denominated physical crude purchases from international refiners. Furthermore, with Strategic Petroleum Reserve (SPR) levels remaining well below historic multi-decade averages, sovereign policy options to suppress future energy spikes via emergency crude releases remain structurally constrained. Physical inventories and supply-demand dynamics. Turning to physical market balances, the latest weekly report from the U.S. Energy Information Administration confirms a commercial crude inventory build of 2.0 million barrels, bringing total U.S. commercial stocks to 411.7 million barrels. This inventory accumulation is further supported by robust domestic production, with U.S. weekly crude output holding near a record 13.8 million barrels per day, demonstrating that domestic supply is comfortably meeting current refinery inputs of 17.1 million barrels per day. At the same time, OPEC Plus continues to enforce production quota discipline to maintain a structural price floor, while refinery crack spreads remain healthy enough to support steady crude processing runs across major global refining hubs. High-impact USA stock winners. For U.S. equity investors, crude oil maintaining levels above $80 per barrel continues to generate exceptional free cash flow yields for integrated energy majors. The premier upstream leader in the U.S. market is ExxonMobil, NYSE, XOM, with low break-even extraction costs and massive global refining scale. Every $10 expansion in realized crude pricing generates billions in additional operational cash flow to back share buybacks and growing dividends. Our second key energy winner is Chevron Corporation, NYSE, CVX. Chevron features a fortress balance sheet and top-tier asset positioning in the Permian Basin, allowing it to capture strong operating margins without expanding debt loads or over-capitalizing new drilling rigs. For broad sector exposure across upstream producers and oilfield services, the Energy Select Sector SPDR Fund, NYSE, XLE, offers a high-yielding, liquid vehicle to play broad energy equity momentum. Squeezed USA stock losers. While energy producers benefit from sustained crude pricing above historical baselines, sudden volatility and elevated fuel costs create direct input headwinds for downstream U.S. sectors. Commercial airlines represent the first wave of margin compression, as jet fuel accounts for roughly 30% of operating expenses, directly eroding quarterly net margins when ticket prices cannot offset fuel spikes. The second major sector facing margin pressure includes global freight, trucking, and logistics networks. Elevated retail diesel prices increase transport costs across corporate supply chains, compressing operating margins for transportation firms that lack dynamic fuel surcharge pass-through mechanisms. Identifying these cost-sensitive sectors helps you manage downside risk when energy markets undergo rapid geopolitical repricing cycles. Forward look and technical roadmap. Looking at the technical chart roadmap for WTI crude futures, $81.50 per barrel serves as primary institutional support, with $84 acting as a key short-term floor. To the upside, a technical breakout back above $88 opens the pathway toward the target resistance zone between $91.50 and $95 per barrel. Over the coming week, institutional traders will monitor official AIR weekly petroleum status reports, upcoming CPI prints, and further diplomatic updates regarding Middle East shipping routes. Maintain a disciplined allocation approach by treating pullbacks toward technical support as potential accumulation zones for Tier 1 energy majors like ExxonMobil, XOM. To see how oil shocks tie directly into our daily coverage of the S&P 500, click the video on screen right now to watch our full US market breakdown. Subscribe to Global Macro Pulse, and we will see you in the next update.